Hey everyone, and welcome back.
So today we're diving deep into the investment strategies of Warren Buffett.
Oh yeah, the Oracle of Omaha.
Yeah,
We
exactly.
got some excerpts here that I think really shed light on his approach.
Hmm.
And, this guy turned investing into an art form.
Well,
Essentially.
he is arguably the most successful investor of all time.
Yeah,
And what's fascinating is that his core principles are surprisingly straightforward.
that's right.
All right, so let's unpack this.
Okay.
First up, the magic of compounding.
I always find it amazing that even Einstein was in awe of this concept.
Like he called it the most powerful force in the universe.
It's true, and for good reason.
I mean, it's pretty powerful.
Compounding is like a snowball effect where your money earns interest, and then that interest earns interest, and so on.
Yeah.
It creates exponential growth over time.
So imagine this, you invest $10,000 with a 9% annual return,
Right.
which is a pretty typical average for the stock market. Without compounding, you'd end up with a little over $67,000 after 50 years.
Not too shabby.
Yeah, not bad.
But here's where it gets mind-blowing.
With compounding.
That same investment grows to almost $230,000.
Yeah.
It's the difference between a cozy retirement and, sipping cocktails on your own private island.
Right.
And to make it even more incredible, if you were to add just $200 a month to that investment.
Oh, wow.
With compounding, you'd be looking at over $1.2 million after 50 years.
That's wild.
The key takeaway is that consistency, even with small amounts, can lead to incredible results over time.
Yeah, that's insane.
And it really highlights the importance of playing the long game.
Which leads us to another crucial aspect of Buffett's approach,
Okay.
keeping emotions out of investing.
It's so easy to get caught up in the hype, buying when everyone's excited and selling when panic sets in.
You're absolutely right.
Buffett often compares investing in the stock market to buying a farm.
Oh, interesting.
Think about it.
Okay.
People tend to be far more rational with tangible assets.
They don't freak out and sell their farm just because corn prices dip for a week.
Right.
They understand that the farm's value is rooted in something more substantial.
That's such a great analogy.
It makes perfect sense.
Buffett once said, and I love this quote,
If you have a temperament that makes you get fearful when others are greedy, you're probably not going to make a lot of money in stocks.
it seems like his philosophy is all about staying calm and collected amidst the market's ups and downs.
Exactly. It's about cultivating patience, doing your research, and making informed decisions based on logic.
Not on the fleeting emotions of the market.
Right.
And speaking of logic over emotion, let's dive into the 2008 financial crisis.
Oh, yeah,
Remember that.
of course.
While everyone was running for the hills, Buffett saw opportunity amidst the chaos and invested heavily in Bank of America.
That takes some serious guts.
What was he thinking?
Well, he was putting his famous advice into action.
Okay.
Be fearful when others are greedy and greedy when others are fearful.
He understood that fear had driven prices down to a point where they didn't reflect the true value of these companies.
Okay.
It was a classic buying opportunity.
So he basically bought stocks on sale during the crisis.
Hmm.
And I'm guessing that paid off pretty well for him.
It did?
He turned that investment into a multi-billion-dollar win, demonstrating that crises can actually present unique opportunities.
For those who can maintain a long-term perspective and a cool head.
That's incredible.
Now let's shift gears a bit and talk about something Buffett is notoriously cautious about.
Okay.
Debt.
He's a firm believer in avoiding borrowing money to invest.
That's interesting.
Why is he so against using debt?
Most people would think it's a good way to amplify gains, right?
The problem is that leverage, as it's called, can be a double-edged sword.
Okay.
While it can amplify gains in a rising market.
It also magnifies losses when the market takes a downturn.
Oh, I see.
So imagine this. You borrow money to buy stocks,
Okay.
and the market drops,
Suddenly you owe more than your investment is worth.
Yeah.
This can lead to something called a margin call.
where your broker forces you to sell your investments at the worst possible time to cover your losses.
So it's like a financial trap that can wipe out your savings.
Precisely.
Buffett often shares the story of Rick Guerin, a brilliant investor who leveraged himself heavily and ended up losing everything when the market turned against him.
Oh, wow.
It's a stark reminder that while debt can seem tempting,
It can also lead to devastating consequences.
okay, debt is definitely something to be cautious about.
So if Buffett's not leveraging his investments, what's the secret sauce?
How does he choose what to invest in?
Well, his core strategy revolves around the concept of value investing.
Okay.
He's famous for saying, price is what you pay, Value is what you get.
He's not interested in chasing the latest hot stocks or trends.
He's looking for companies that are fundamentally strong but are currently undervalued by the market.
So he's basically looking for hidden gems,
Exactly.
companies that the market is overlooking.
A great example is his investment in Apple back in 2016. He bought a huge chunk of the company's stock when its price-to-earnings ratio, or PE ratio, was relatively low.
Hold on, what's a PE ratio again?
It's a way to measure a company's value relative to its earnings.
A lower PE ratio often suggests that a company is undervalued.
Got it.
Buffett saw that Apple had a strong brand, a loyal customer base, and was generating tons of cash.
The market, for whatever reason, wasn't fully recognizing this value, so he swooped in.
And I bet that turned out to be a pretty smart move.
You could say that.
His investment in Apple has grown more than 7-fold since then, highlighting the power of identifying undervalued companies with strong fundamentals.
That's incredible.
So it's not just about finding a good deal.
Why?
It's about understanding the true worth of a company.
But how do you even begin to figure that out?
I mean, it's not like there's a price tag on a company's future potential.
You're right, it's not that simple.
And that's where another crucial aspect of Buffett's approach comes in,
Okay,
his concept of the circle of competence.
I've heard that term before.
What's the deal with this circle?
Essentially, it means sticking to what you know.
Buffett only invests in businesses he understands thoroughly.
Okay.
He doesn't try to be a jack of all trades or chase every hot trend.
He believes that having a deep understanding of a particular industry or sector gives him an edge when evaluating companies within that realm.
So it's about recognizing your strength and focusing your energy on areas where you have real expertise.
Exactly.
It's okay to say no to opportunities that fall outside your circle of competence, even if everyone else seems to be making money hand over fist.
Trying to invest in something you don't truly understand is a recipe for disaster.
That makes a lot of sense.
It's like trying to perform surgery without any medical training.
You're bound to make some serious mistakes.
Right.
So if Buffett's not chasing every trend, how does he decide which opportunities are worth pursuing?
Well, a great example of his circle of competence in action was during the dot-com bubble in the late 1990s.
Oh, yeah.
Remember that?
Yeah.
Everyone was going crazy for internet stocks.
Pouring money into companies with unproven business models and sky-high valuations.
Buffett, on the other hand, largely stayed on the sidelines.
Why didn't he jump on the bandwagon?
Was he just being stubborn?
He wasn't being stubborn, he was being prudent.
He recognized that he didn't fully understand the internet industry or the dynamics of these new business models.
Okay.
He felt that the valuations were inflated and that the hype was unsustainable.
So he chose to sit out the party, even though it meant missing out on some potential short-term gains?
And I'm guessing that turned out to be a wise decision in the long run.
Absolutely.
When the dot-com bubble burst, many investors who had poured their life savings into internet stocks lost everything.
Buffett, because he stayed within his circle of competence and resisted the temptation to chase the hype, emerged from the crash relatively unscathed.
Wow. That's a powerful lesson in the importance of sticking to what you know.
So we've covered compounding emotional control, value investing, and the circle of competence.
What else is there to learn from the Oracle of Omaha?
Well, there's one more crucial piece to the puzzle that we haven't touched on yet, and it might surprise you.
Okay, I'm intrigued.
Liquidity.
Liquidity,
Buffett always maintains a large cash reserve.
which might seem counterintuitive at first.
Yeah, I was going to say.
Wouldn't he want to have all his money invested and working for him?
Yeah, that's what I would think.
Why does he keep so much cash on hand?
Isn't that like letting your money gather dust?
Not at all.
Having a significant cash cushion gives him incredible flexibility and resilience, especially during market downturns.
Okay.
When everyone else is panicking and selling off assets, he's in a position to swoop in and buy undervalued companies at bargain prices.
So it's like having a secret weapon.
That allows him to capitalize on opportunities that others miss.
Precisely.
It's like having dry powder ready to deploy when the perfect target appears.
I like that.
But it's not just about being opportunistic.
It's also about peace of mind.
Okay.
Knowing he has a substantial financial buffer allows him to stay calm and rational even when the market is going haywire.
That makes sense.
It's like having an emergency fund for your investments.
So liquidity is a key part of his risk management strategy.
Is that what you're saying?
You got it.
It's about not putting all your eggs in one basket.
And ensuring that you have the financial flexibility to navigate unexpected events and capitalize on future opportunities.
Okay, so we've covered compounding emotional control value, investing, the circle of competence, and the importance of liquidity.
That's a lot to digest.
That wraps up part one of our deep dive into the investment strategies of Warren Buffett.
That's right. We've laid a solid foundation, but there's still much more to explore.
Join us next time as we delve deeper into the nuances of his approach and uncover even more valuable insights.
Welcome back.
I'm still buzzing from all the wisdom we unpacked in part one.
About Warren Buffett's investment strategies.
Nah,
That guy's a legend.
he really is.
And we've only just scratched the surface.
Today, let's dig even deeper into some of the concepts we touched on,
Okay.
like the power of having a cash reserve.
And that brilliant analogy of approaching the stock market with the same mindset as buying a farm.
Oh, yeah, I loved that analogy.
It's such a simple yet profound way to illustrate the importance of focusing on the long game.
And not getting spooked by short-term market fluctuation.
Exactly.
Buffett argues that people are far more rational when it comes to investing in tangible assets like farmland.
They don't panic and sell just because the price of corn dips for a week.
Right.
They understand that the farm's true value is based on its long-term potential to generate income and appreciate in value.
It's about seeing the bigger picture, right? Not getting caught up in the day-to-day noise of the market.
Precisely.
And that brings us to another critical concept that we briefly mentioned,
Okay.
the difference between price and value.
Remember Buffett's famous quote?
Oh, yeah?
Price is what you pay, value is what you get.
I do.
He's essentially saying that the stock market is often driven by short-term speculation and emotion.
Which can lead to prices that don't reflect a company's true worth.
So how do you actually figure out a company's intrinsic value?
Like, what are you looking for?
That's where the real work comes in.
It's about digging into a company's financial statements, understanding their business model, analyzing their competitive landscape.
And assessing their long-term growth potential.
It's not about trying to predict short-term price movements.
It's about identifying companies that are trading at a discount to what they're actually worth.
Kind of like finding a hidden gem at a flea market.
Exactly.
Buffett's investment in Apple is a perfect example.
Oh, yeah.
He saw that the company had a strong brand, a loyal customer base, and was generating a ton of cash flow. But for some reason, the market wasn't fully appreciating these factors.
And the stock was trading at a price that he felt was below its intrinsic value.
So he swooped in and bought a massive chunk of the company, right?
He did.
And that investment has since grown exponentially.
Demonstrating the potential rewards of value investing.
But it's important to note that this approach requires patience and discipline.
It's not about getting rich quick. Okay.
It's about identifying undervalued companies and holding them for the long term.
Allowing their intrinsic value to be reflected in their stock price.
This reminds me of another concept we talked about.
The circle of competence.
Right.
Can you explain how that ties into value investing?
Absolutely.
Remember, Buffett only invests in businesses he understands thoroughly.
He believes that sticking to industries and companies within his circle of competence
Gives him an edge when it comes to evaluating their true value.
He's not trying to be an expert in everything.
He's focusing his energy on areas where he has a deep understanding of the underlying dynamics.
It's like becoming a master chef in a specific cuisine instead of trying to cook every type of food under the sun, right?
Yeah, exactly.
And a great example of this principle in action was during the dot-com bubble in the late 1990s.
Oh, yeah, I remember that.
While many investors were pouring money into internet companies they didn't fully understand.
Buffett largely stayed on the sidelines.
Wasn't that kind of risky?
I mean, he could have missed out on some serious gains, right? He could have. But that's where his discipline and commitment to his circle of competence come in.
He recognized that he didn't have the expertise to accurately evaluate these internet companies.
Okay.
So he chose to sit out the frenzy.
He didn't let FOMO or the fear of missing out drive his decisions.
So he basically avoided the whole dot-com crash.
That's pretty impressive.
It is.
And it highlights a crucial point.
Okay.
It's okay to say no to opportunities that fall outside your circle of competence, even if everyone else seems to be making a killing.
Sometimes the best investments are the ones you don't make.
That's a great reminder to stay focused.
And avoid getting distracted by shiny objects.
Right.
But let's be honest, it's hard not to get caught up in the hype.
When the market is going crazy.
It is.
And that's why Buffett emphasizes the importance of emotional control.
Remember his famous advice.
Oh, yeah.
Be fearful when others are greedy, and greedy when others are fearful.
Right.
He believes that fear and greed are two of the most powerful forces that drive market cycles.
So when everyone is euphoric and buying like crazy.
That's actually a sign to be cautious.
Exactly.
When prices are driven up by irrational exuberance.
It creates a bubble that's bound to burst eventually.
On the other hand, when fear takes hold, and everyone is selling in a panic.
It often creates opportunities to buy undervalued assets at bargain prices,
So it's about being contrarian.
going against the crowd.
In a way, yes.
But it's not about blindly doing the opposite of what everyone else is doing.
Okay.
It's about making rational, informed decisions based on your own analysis and understanding of the market.
It's about recognizing that the market is often driven by emotion and short-term thinking.
And that by staying disciplined and focused on the long term, you can potentially capitalize on these swings.
This reminds me of Buffett's actions during the 2008 financial crisis.
He wasn't afraid to invest when everyone else was running for the hills, right?
That's right.
He saw the crisis as an opportunity to buy quality companies at deeply discounted prices.
He invested billions of dollars in companies like Goldman Sachs and Bank of America,
Wow.
betting that they would recover once the panic subsided.
And I'm assuming that bet paid off pretty handsomely.
It did,
Those investments turned into multi-billion-dollar wins.
solidifying his reputation as a master of value investing and a shrewd judge of market sentiment.
So it's not just about identifying undervalued companies.
It's about having the courage to act when everyone else is frozen by fear.
Precisely.
But it's important to note that this doesn't mean blindly buying anything that's down in price.
Okay.
You still need to do your research and make sure that the underlying business is sound and has a solid long-term outlook,
It's about finding value in the midst of chaos.
not just catching falling knives.
Exactly.
Now let's move on to another topic that's closely related to emotional control,
Okay.
the dangers of leverage or borrowing money to invest.
You mentioned this earlier when we were talking about margin calls.
Right.
Why is Buffett so against using debt in investing?
He sees it as an unnecessary risk.
Remember, when you borrow money to invest, you're essentially amplifying your potential gains and losses.
Okay.
If the market goes up, you make more money.
But if the market goes down, you lose more money, potentially even more than you initially invested.
It's a high-risk, high-reward strategy.
It can be.
And while some investors may be comfortable with that level of risk,
Buffett prefers to err on the side of caution.
he believes that protecting your capital is paramount,
Okay.
and that taking on unnecessary debt can jeopardize your long-term financial security.
He's all about preserving wealth and avoiding unnecessary risks.
Exactly.
And he often cites the cautionary tale of Rick Guerin, a brilliant investor who lost everything because he leveraged himself too heavily.
Oh, wow.
Guerin's story serves as a stark reminder that while debt can be tempting,
It can also lead to financial ruin.
so it's better to play it safe and invest within your means.
That's generally Buffett's philosophy.
He believes that slow and steady wins the race when it comes to building wealth.
Okay.
It's not about getting rich quick.
It's about making smart, informed decisions, managing your risk, and allowing your investments to grow over time.
Okay, so we've covered the importance of emotional control and the dangers of leverage.
What other gems of wisdom can we learn from the Oracle of Omaha?
Well, there's another key element of his approach that we haven't talked about yet, and it might surprise you.
Okay, what is it?
Patience.
Patience.
Isn't investing all about making moves and seizing opportunities?
It's about both.
But Buffett is a firm believer in the power of long-term thinking.
Okay.
He's not interested in chasing quick profits or trying to time the market.
He's looking for companies he can hold for years, even decades, allowing the magic of compounding to work its wonders.
So it's about finding great companies and letting them grow over time.
Exactly.
And this ties back into his concept of the circle of competence.
He's only investing in businesses he understands thoroughly.
And he's willing to wait patiently for those companies to reach their full potential.
Like he did with Apple.
Exactly.
He saw the long-term potential of the company.
And was content to hold his shares even when others were doubting Apple's future.
And of course, his patience paid off handsomely.
It's about trusting your instincts.
And having the conviction to stick with your investments even when the market is testing your patience.
That's a great way to put it.
And this long-term mindset applies not only to individual stocks.
But to the overall market as well.
Okay.
Buffett believes that the stock market is inherently volatile in the short term.
But over the long run, it tends to reflect the growth of the economy.
So it's about riding out the ups and downs.
And not getting spooked by temporary setbacks.
Precisely.
It's about recognizing that market fluctuations are a natural part of the game.
And that trying to time the market is usually a losing proposition.
This reminds me of another concept we talked about.
The importance of maintaining a cash reserve.
Yeah,
Can you explain how that ties into his long-term philosophy?
absolutely.
Having a significant cash cushion allows Buffett to stay calm and collected, even when the market is going through turbulent times.
He knows that he has the financial flexibility to weather any storm.
And that he doesn't need to make rash decisions out of fear or desperation.
It's like having a financial safety net.
That allows you to stay rational and make informed decisions even when everyone else is panicking.
You got it.
And it also gives him the ability to seize opportunities when they arise,
Okay.
when the market crashes and prices drop.
He can use his cash reserves to buy undervalued assets at bargain prices.
So liquidity is not just about risk management.
It's also about being able to capitalize on market downturns.
Precisely.
It's about having the financial firepower to act decisively when others are forced to sell.
Okay, so we've covered a lot of ground in part 2.
Can you give us a quick recap of the key insights we've gleaned from Warren Buffett's approach?
Sure.
We've talked about the importance of understanding the difference between price and value.
The power of sticking to your circle of competence, the need for emotional control, the dangers of leverage.
And the virtues of patience and maintaining a healthy cash reserve.
Those are some powerful principles.
And it's clear that they've played a major role in his incredible success.
But how can we, as everyday investors, apply these principles to our own lives?
That's a great question.
And it's one we'll delve into in part 3 of our deep dive.
Okay.
We'll explore some practical tips and strategies.
For incorporating Buffett's wisdom into your own investment journey,
Sounds great.
I'm eager to learn how to put all this knowledge into action.
Welcome back to the final part of our deep dive into the investment strategies of Warren Buffett.
It's been a fascinating journey exploring his approach.
Oh, really, yes.
We've uncovered some real gems of wisdom, from the power of compounding to the importance of emotional control, value investing, and the magic of having a cash cushion.
We've also talked about the circle of competence and how crucial it is to stick to what you know.
That's right. It's been eye-opening to see how these seemingly simple principles, when applied consistently, can lead to extraordinary results.
But now the big question is, how can we as everyday investors actually put this wisdom into practice?
That's the million-dollar question, isn't it?
It is.
It's one thing to understand these concepts in theory.
But quite another to apply them in the real world.
Exactly. So let's break it down.
Okay.
If we were to distill Buffett's approach into some actionable takeaways, what would be the top 3 things listeners should focus on?
Okay, great question.
I think the first and most fundamental takeaway is to shift your mindset from short-term speculation to long-term investing.
Okay.
Remember, Buffett is known for his patience. He's not trying to time the market or chase quick profits.
He's looking for companies he can hold for years, even decades, allowing the power of compounding to work its magic.
So it's about finding those companies that you believe in for the long haul.
And then resisting the urge to react to every little market fluctuation.
Exactly. It's about tuning out the noise and focusing on the fundamentals of the businesses you own. This means developing a clear investment plan based on your goals, your risk tolerance, and time horizon.
And then sticking to it even when the market gets turbulent.
Easier said than done right.
I mean, it's hard not to get spooked when the market takes a nosedive.
It is.
That's why emotional control is so crucial.
Remember, fear and greed are 2 of the most powerful forces that drive market cycles.
Right.
When everyone is panicking and selling, that's often the best time to buy.
And conversely, when everyone is euphoric and buying like crazy, that's often a sign to be cautious.
So it's about being contrarian.
Going against the herd mentality.
And yes.
But it's not about blindly doing the opposite of what everyone else is doing.
It's about making rational, informed decisions based on your own analysis and understanding of the market.
Okay.
It's about recognizing that the market is often driven by emotion and short-term thinking.
In that by staying disciplined and focused on the long term, you can potentially capitalize on these swings.
Okay, that makes sense.
So shift to a long-term mindset and master your emotions.
What's the third key takeaway?
The third takeaway builds on something we've touched on throughout this deep dive.
Yeah.
The circle of competence.
Remember, Buffett only invests in businesses he understands thoroughly. He's not trying to be an expert in everything. He's focusing his energy on areas where he has a deep understanding of the underlying dynamics.
So how do you actually figure out your own circle of competence?
What does that look like for everyday investors?
It starts with self-awareness.
Okay.
Think about your skills, your knowledge, your experiences.
What industries or sectors do you find genuinely interesting?
What companies or business models do you feel like you understand at a deeper level?
So it could be anything from technology to retail to healthcare.
It's really about where your passions and interests lie.
Exactly.
And it doesn't mean you need to be a financial expert or have a degree in business.
It's about leveraging your existing knowledge and experience to gain an edge when evaluating investment opportunities.
So, for example, if you've worked in the tech industry for years,
Right.
you might have a better understanding of the competitive landscape and the key trends shaping that sector.
Which could give you an advantage when evaluating tech companies. Precisely.
Or, if you're a passionate gamer, you might have a deeper understanding of the video game industry and the factors that drive its success.
The key is to identify your areas of expertise.
And then focus your research and investment efforts within those realms.
That makes a lot of sense.
It's like becoming a specialist instead of trying to be a generalist.
Right.
So once you've defined your circle of competence, how do you actually go about finding those undervalued gems that Buffett is so famous for uncovering?
Well, it starts with research, of course.
Reading financial statements, analyzing industry trends, studying the competitive landscape.
And understanding the key factors that drive a company's success.
But it's also about developing a framework for evaluating value.
What kind of framework are we talking about?
There are many different valuation methods.
But at its core, it's about comparing a company's current stock price to its intrinsic value.
Okay.
Remember, price is what you pay, value is what you get.
Right.
You want to look for companies that are trading at a discount to their true worth, essentially buying dollar bills for 50 cents.
So it's like finding a hidden treasure that everyone else has overlooked.
Exactly.
And while there's no magic formula for identifying these hidden gems.
There are some key indicators that Buffett looks for.
Okay, like what?
Like a strong track record of profitability, a solid balance sheet, a sustainable competitive advantage.
And a management team that's aligned with shareholder interests.
So it's about doing your homework.
And really digging into the nuts and bolts of a company.
Yes. And it's also about being patient.
Remember, value investing is not about getting rich quick.
Right.
It's about identifying undervalued companies and holding them for the long term.
Allowing their intrinsic value to be reflected in their stock price.
This requires discipline and the ability to resist the temptation to chase the latest hot stocks or trends.
Right, because as we've learned, chasing trends is usually a recipe for disaster, especially if they fall outside your circle of competence.
Exactly.
And speaking of risk, it's important to remember that no investment is without risk.
Even the most carefully chosen stocks can lose value, especially in the short term.
Right.
That's why it's crucial to manage your risk carefully.
And never invest more than you can afford to lose.
So diversification is key.
Don't put all your eggs in one basket.
Absolutely.
Spreading your investments across different asset classes, industries, and companies
Can help to mitigate your overall risk.
And as we've learned from Buffett, maintaining a healthy cash reserve.
Can provide a buffer against market volatility and give you the flexibility to seize opportunities when they arise.
So it's not just about maximizing returns, it's also about protecting your capital.
Exactly.
It's about striking a balance between risk and reward and developing a strategy that aligns with your individual goals.
Risk tolerance and time horizon.
Well, I think we've covered a lot of ground today, and I feel like I've gained a much deeper understanding of Warren Buffett's investment philosophy.
Any final words of wisdom for our listeners before we wrap up this deep dive?
I think the most important thing to remember is that successful investing is not about some secret formula or magic touch.
It's about developing a disciplined approach, a focus on fundamentals, a long-term perspective.
And a commitment to emotional control and risk management.
And it's about finding joy in the process of learning and growing as an investor, wouldn't you say?
Absolutely.
Investing can be a fascinating and rewarding journey.
And by incorporating some of the key principles we've gleaned from the Oracle of Omaha, you can increase your chances of success and achieve your financial goals.
Well said. Thanks for joining me on this deep dive into the world of Warren Buffett.
It's been a pleasure.
I hope our listeners have found it as insightful and inspiring as I have.
Happy investing, everyone.